Welcome to the Economic Rockstar Podcast with your host, Frank Conway, connecting brilliant minds in economics and finance.
Hello and welcome back to another episode of the Economic Rockstar Podcast. In this week's episode, I speak with Professor Stephen Wright, who is Professor of Economics at the Department of Economics, Mathematics and Statistics at Birkbeck, University of London. I've been meaning to get Stephen on for the last couple of years. I think I first reached out to him back in October 2016, so exactly 2 years to the date. And we have finally got the chance to speak to one another. And I actually lecture on a module called Financial Economics, and within that I teach a topic called stock market valuation techniques. And I look at price earnings multiples as written about by Bob Shiller. But I also look at Tobin's Q, or Q, which has been well researched by Stephen Wright and Andrew Smithers. And back in 2000, Bob Shiller released Irrational Exuberance and used the price earnings multiple to identify whether the stock market was overvalued or not over a historical time period. And he had expressed in 1999-2000 that indeed it was based on that indicator. But coinciding with that release of Irrational Exuberance, Stephen Wright and Andrew Smithers also released a similar book called Valuing Wall Street, Protecting Wealth in Turbulent Markets, and they used the Q ratio, which was initially found by James Tobin, who is a Nobel Prize winner in economics. And they used this ratio, or a slight variation to the ratio, to identify a very similar conclusion to Bob Shiller, that the market was indeed overvalued. And based on the two valuations, we saw in hindsight that the market was at the time overvalued, and we saw a sudden decline. And we're here back again to discuss this type of indicator with Stephen, and we're using the Q ratio to identify, again, is the stock market overvalued today, 2018? And looking at some of the charts that Stephen has provided during this conversation, we indeed find that the market seems overvalued, very similar to what it was in 1929 and a little bit below what we saw in 2000. So a good discussion on the stock market and its value was played out in the conversation today, but Stephen admits that he's not in the game to predict and forecast. He's just showing, based on his research and the data that he collects, that the market could indeed be overvalued. And because he admits that some of the fundamentals could be in error, such as earnings in the price earnings ratio, or even some of his own data for Q, because not discrediting the work of accountants, but sometimes the valuation of firms could indeed be overvalued in terms of their assets. And therefore, in order to avoid looking at potential errors in the fundamentals used in the measuring of these indicators, such as the Q ratio, he decided to look at an alternative indicator, which looked at a geometric weighted average of current to past stock market returns. And he found that they seemed to have followed the very same pattern as the Q ratio over a 120-year period, showing the highs and the lows marked by the peaks and the troughs of the stock market returns in terms of 29, the 1930s, and then also in 1999. But one interesting thing that he has found in this chart was that the indicators seem to become disconnected in the mid-1990s onward. And this is very interesting, given that the Q ratio is indicating that the market is twice overvalued relative to the historical average, whereas his new indicator is indicating that the market is bang on value. So questions arise as to which is correct, and he just has to point out a ballpark figure, which is the average of both of them. So his current calculations, or his current estimates, is that the market is 1.5 times overvalued than its historical average, which may indicate that future returns in the short term could be lower than what we have had experienced recently, whether it's going to be showing negative returns or lower positive returns. So this conversation referred to a couple of diagrams. I will put them on the website, economicrockstar.com/Stephen Wright, and that's StephenWright. So go to that, or go to economicrockstar.com/podcasts, or check out the conversation on YouTube, where we'll be able to look at the charts live as we have that conversation with one another. So again, thanks very much for listening, and as always, please share this episode with those people that could have some interest in this, whether they're in academia or whether they're a stock market investor who may have been aware of the Q ratio or may not be, and it would be nice to be somewhat exposed to this and see if they could integrate it into their own valuation calculations or their own understanding of the stock market today. And if you want to support the show for as little as $1 a month, check out my Patreon page at patreon.com/economic rockstar. I'd really appreciate any support. But preferably, if you're listening on Apple Podcasts, it'd be great if you could subscribe and give an honest rating and a review, or just share if you're on Spotify or any other platform, because that way the podcast will become more noticeable and more people will be able to find me, and we'll be able to build a bigger community of like-minded individuals who love this type of conversations with great academics. So thanks again for listening. Enjoy this episode with Professor Stephen Wright. Hello, Stephen.
Oh, hi, Frank.
Hi, how are you doing? I tried ringing you there twice and it just wouldn't connect at all.
Yeah, it's a weird thing about my Skype. It sort of protects me from unsolicited calls, but I try. For some reason, no one ever manages to call me. I just see the missed calls and then I call them back.
Yeah. So it's great to finally get to speak to you, Stephen, and, you know, it's a long time coming.
Well, there we go. Such is life. I'm sorry I've been a while, but, you know, I'm happy to talk.
Yeah. So how did it go for you yesterday with your presentation?
Yeah, it was fine. It's a session I've done for quite a while. I've been talking about stock markets for too long now, and I'm probably beginning to sound like a broken record. So, but there always seems to be a supply of new people who seem to be prepared to listen. So
that's the nature of things, isn't it? The way of life.
Well, I don't know. I'm curious how you ever come across what I do, because it's not that it doesn't get that much publicity.
Okay, I'm surprised by that, actually. I think about 12 years ago, I wanted to create a new module in the course that I'm delivering, you know, the program that we're delivering here at the college. Mm-hmm. And I wanted something different because I became very disillusioned with the economic discipline and also finance, the theoretical models. And I wanted to do something that will introduce students to other theories or to analyses of theories and see how they actually work in practice, and whether they challenge the likes of the efficient market hypotheses and so on. Okay. So my first topic on this module is stock market valuation techniques, and I just look at price earnings multiple and Tobin's Q, and I introduce a lot of your work, equity Q, and the dividend yield, and we analyze what you have written in your book, Valuing Wall Street. We analyze the criteria that are expected. Really so you knock dividend on the head. You kind of eventually knock price earnings ratio after 3 of the criteria have been accepted, but then fail at the final hurdle. So I bring in stuff like that, like Taleb's Black Swan, and this was all good just in time, like 2 years prior to the financial crisis. Right. And, you know, I'm glad it did it then and not just happened to create this module afterwards in hindsight.
Right. Well, there you go. I'm fascinated. I mean, my book is out of print, so I'm surprised you even managed to get a copy of it.
I have the copy right here. Okay. And what happened was I looked for it at a time and I couldn't get it. And I went in to do a local bookshop here in Waterford, and they said, well, try a Libris. They usually have out-of-print copies that are kind of going around. So I tried a Libris, found it, and bought it. Right. So it was happy days.
Yeah, I mean, it's a shame because it was a book of its time, fairly obviously. It sold quite well at the time, and then it just completely slumped because it was, you know, a lot of it was only about 1999, basically. But there is, you know, if I had all the time in the world, I probably would write a second edition that would not be sort of time dated in its way, and I think might well be of interest, but I have no idea when I would have the time to do that, so there you go.
Well, Robert Shiller had his PE one, Irrational Exuberance, and because that was stuck in 1999 as well, he eventually came out just in time of the financial crisis and talked about the other type of irrational exuberance in terms of housing. So
no, I mean, Robert Shiller, though, I don't know how he has the energy to do what he does. He's
Nobel Prize.
Well, yeah, I mean, he gets his Nobel Prize, but he's an incredibly energetic guy. I don't know, he must be incredibly focused, or he doesn't have any of the kind of distractions that you and I as practicing academics probably do have. I don't know. I mean, I spend an awful lot of time just worrying about my students, and getting to do anything else is always difficult.
Yeah.
Anyway, so how do you want to play this? Are we already on tape?
Oh, I've been recording it so far, so it's just as well you didn't say anything bad about your students.
But yeah, okay. Well, so over to you, really.
Yeah, well, I suppose we'll transition into it a little bit, maybe introducing yourself and how you actually got into the economics discipline.
Right.
And
okay.
what were your formative years regarding that type of thinking? And was there something before economics? Was it just a coincidence that you came across it?
Okay. Well, yeah, I did come into economics relatively late. I didn't have the slightest interest in it at school. I also didn't like maths at school. I was more interested in other stuff, more sort of, I don't know, various other stuff. I don't need to go into the details of the various other stuff.
What era are you talking about? What decade?
This is in the late 70s. I was at school. And when I left school, I didn't want to go to university, so I didn't go to university. So I actually went to university 6 years late.
Okay. Would you have been a punk?
I wasn't a punk.
Anarchy.
Nor was an anarchist. Nor did I spend time in prison or anything like that. But it's interesting because actually, aside from economics, one of the things I've learned from that experience is I'm a great fan of students not going to university unless they really want to go to university. I think too many students drift into going to university because they can't think of anything better to do.
True.
And I think if they can't think of anything better to do, they'd be better off working at McDonald's. Or, working at McDonald's for a while, then traveling or something. But anything other than just wasting time at university. I don't think people should go to university until they really want to go to university. Possibly until they don't feel they have any alternative,
It's mad you say that because I had a conversation with Kevin Kelly of Wired magazine there last night, and he said the same thing. He dropped out of college after 1 year and decided to do a lot of traveling, and it wasn't until his mid-30s that he found what he really wanted to do, which was the whole Earth review, that catalogue, and then moving on to Wired magazine. So yeah, a lot of people actually do that. Brian Kaplan of George Mason actually says that about education too. It's not necessarily just because you feel the need to go on to this next stage of your life. It's not always the best choice. And that's what you found yourself.
Yeah, absolutely. And I think I've seen it. I see it in so many of my students who basically leap into it drift into doing a degree and then don't really think it's, they're not sufficiently interested in it or ready to do it really, I think. So I can't claim that it was any great plan though, because when I did finally go to university, it was more because I thought that I sort of should, because I wasn't getting anywhere else in life. Even then I didn't really want to study economics. I thought I wanted to study politics, but I did an economics degree. I started an economics degree where there was some politics in the first year. And 1 year's worth of politics modules was quite enough for me, and I decided that I did quite like economics. And so yeah, I then just progressively got into the subject. And it's interesting you were talking about sort of non-mainstream economics, because I think of myself as being, if anything, a quite hardline mainstream economist. I'm a fan of economics, and I think it gets a bad name, partly because of the way quite a lot of mainstream economists fail to present the subject. I don't know if you've been using this in your university, but are you aware of the CORE project, the new online resource for teaching economics?
Okay, no.
Okay, well, yeah. I'll send you the link and you can put it up if you want.
Yeah.
Because it's a new teaching project that's teaching, I would say, mainstream economics, but in a much more refreshing way for people new to economics. And I've been using that for the last 3 years.
Is this in the UK only, or is this?
No, it's an international. It's set up in the UK, but it's very much an international collaboration.
Yeah.
So anyway, I mean, you were coming back. You were asking me about me as an economist. Well, as I said, I'm a mainstream economist, and yes, when we look at stock markets, the sort of thing I'm doing is not completely in line with what you would get in a standard finance course. But I think I would argue that's because standard finance courses are about 20 years behind the time. There's been so much research in mainstream economics and finance that is, actually supportive of what I do in these presentations. And I'm not, I'm reasonably well aware of that literature. And I don't think anything that I say is very far out of line with that literature. If you look at people like Cochrane, Campbell, and co-authors, I don't think they would disagree very much with what I'm saying. Maybe Eugene Farmer would, but he's pretty hard line.
Yes.
But even Eugene Farmer actually would acknowledge has done work on a lot of stuff where the empirical evidence, where he would agree on the empirical evidence. It's actually the interpretation of the empirical evidence that's I think is still the battleground in this.
Even Farmer's work on the efficient market hypothesis, that being released has brought about a good debate anyway. The outcome of that has been very positive.
Yeah, absolutely. I mean, he has strong ideas. But I mean, I have a tremendous respect for what he's done. And indeed, a lot of what I'm doing is drawing on what he's done over the years, but with a somewhat different perspective.
Because what you're doing is building on James Tobin's work on Tobin's Q. So that kind of goes against EMH in that there's mean reversion and so on in it.
I mean, we need to be careful here.
Yeah.
Over the years, I've been convinced by the arguments that actually the inefficient markets hypothesis is not a testable hypothesis at all. And as such, Andrew Smithers, who I've worked with in the past, just basically says because it's not testable, it's not a useful concept because he says all scientific hypotheses should be testable. There's basically in the efficient markets hypothesis, you always have the joint hypothesis problem that it depends which bit, when you reject something, you don't know which bit of the model you're rejecting. You're still seeing my screen here, are you?
I see the CAPE and Q.
Yeah. Okay. So, here's, in a sense, a case in point. Okay. So just to set the scene, I mean, you obviously know this, but, for those listening, these are two commonly used, well, one of them is a very commonly used indicator of stock market value, CAPE, the cyclically adjusted PE multiple, particularly publicized by Schiller. Where what you do is you take the stock price, instead of dividing it by 1 year's worth of earnings, you divide it by 10 years worth of earnings, and you strip out the effect of inflation. And that's one of the measures here. The other measure which Andrew Smithers and I advocated back in our book in 2000, and from work we've been doing previously, was, as you say, Q, which is actually not quite Tobin's Q. That's why we just call it Q, because Tobin's Q was thought of in the context of the total enterprise value of a company, so the total value of equity plus debt. Whereas we're only looking at the value of equity, and we're comparing that therefore to the net worth of the company. Just checking, you still there?
I'm still here. Fine. Okay. You couldn't do me a favour. See where my FC is to call. You wouldn't mind just dragging that a bit to the right or something, just so we can see the. Perfect. So
that's better. Okay. Yeah. So that's one. So the other one, the blue line, Q, is in words, it's relatively simple to describe. It's the ratio between what you pay in the stock market for what you would notionally pay in the stock market if you bought the entire corporate sector of the United States, or the non-financial corporate sector of the United States. Mm-hmm. The price you'd pay in the stock market compared to what the statisticians and the corporate accountants reckon is actually the underlying net worth of the actual underlying assets owned by the American corporate sector. And that was an idea suggested by Tobin, or very closely related to the idea suggested by Tobin, indeed drawing on work from Wicksell and much earlier. and originally thought of as a way of thinking about the incentive to invest. Basically, if the idea was that if Q was above 1, the stock market valued the corporate sector more than at more than the value of its assets, that gave firms an incentive to invest in extra assets, and the idea was that in due course that would bring Q back down again. But in fact, I mean, I think, the evidence has now become pretty strong that when Q comes back down again, it's not really driven by that buy or build rationale at all. It's actually largely driven by the stock market rising and falling. That's what pushes. So both these lines are being pushed up and down by good and bad returns in the stock market.
Yeah.
Just to clarify, the reason they look so similar is that they're not being measured in their natural units. They're both being divided by their historic averages.
Okay.
So they're all being measured relative to their historic average.
And the historic average for the PE is about 16, isn't it? And
a little bit less.
Yeah.
It depends which way it actually matters quite a lot which way you average it. If you take the arithmetic average, it's about 15 or 16. If you take the geometric, for which there's quite a strong argument, it's significantly lower.
Because Jeremy Siegel and Bob Schiller have slightly different averages as well based on their approach to...
Yeah, I mean, I think you can make a very strong case for the geometric average, but, it doesn't really make much difference whichever you do.
Stephen, is your average based on James Tobin's theoretical value of 1, or is it based on your own calculation of 0.67?
No, it's based. So this is in theory, Q should average out at around 1. If it's being properly measured. In the data, it's pretty clear that, in the data, it does not average out to 1. In the data, it averages out to a number around 0.65, something like that. You seem to know it better than I do. But should we be surprised by that? Well, in a sense, it's actually astonishing that the number is so close to 1, given that we're taking data from completely different sources and comparing them. And in fact, I remember talking to people in the Bureau of Economic Analysis about the bottom of the ratio, the capital stock figures that feed into that, and they'd never thought about the fact that they might compare the numbers they produce with the numbers that the stock market, the value that the stock market puts on it. And so, in a sense, it's a sort of an independent test that two sets of people measuring something come up with a number that's really not very far apart. But yes, Q averages out in the raw data at a number less than 1. Without dwelling on it too long, we don't find that all that surprising. It seems likely to be due to the fact that when Q is basically accumulation of retained profits, and if you overstate retained profits, you overstate the net worth figure, which is the bottom of Q. And we think that it's pretty likely that there's independent evidence that profits are systematically overstated. You can also see that in the PE multiple. And so, it sort of hangs together because the PE multiple if you turn the PE multiple upside down to make it the earnings yield, it should average out to be roughly equal to the long run return on stocks.
Okay.
And it doesn't. It ends up being a higher number. And the fact that it's higher is pretty strongly suggestive of the fact that that
earnings
on a fairly systematic basis, companies lie about their earnings.
Yes. That always gets me because when analysts have these expectations about earnings, companies tend to meet these expectations, and there's no real surprises except for situations where a number of companies might beat or underperform. And I always don't get this. Is this because of the accounting practices that analysts have identified?
Yeah, I don't think, like as in many other economic contexts, you just look for the incentives. There is an incentive for accountants to try and get it roughly right. And they do, I think, get it roughly right. Again, the average earnings yield is 7-point-something% in America, and the average return is around 6%. So they're pretty close. Which suggests that, yes, accountants do lie, but they don't lie very much. And it may not even be, sometimes it's lying, clearly Enron and things like that. But often it's not so much lying, it's just, being a bit too optimistic and a bit too generous to their companies, for which they obviously, as some of the discussion recently has pointed out, there is that incentive that it's hard to avoid. But I don't mean to be rude to accountants. I mean, I think, they're trying to do a difficult job, and actually the evidence is they don't do it that badly. But coming back to the chart, so what we've done there is, yes, the red line, the CAPE is CAPE relative to its historic average of around, I think 14, 15. And the blue line is Q relative to its historic average of around, 0.7. And that's the only transformation involved in this chart. Once you do that transformation, you can see that these two series give really very, very similar pictures. And coming back to our earlier discussion, it's a picture that shows these long swings, which you can interpret as overvaluation and indeed undervaluation. And indeed, my conclusion would be that I do interpret it as such. Yeah. But I have to acknowledge that Eugene Farmer would say, no, that's not overvaluation. It's just a change in the discount factor. When the market goes above, it's just that people's desired return, expected return, and then hence discount factor on future earnings has fallen, and that pushes prices up. When it comes back down again, it's just a change in preferences. And there's a long and honourable tradition putting forward this alternative interpretation. I don't think it can be completely dismissed. I think there is evidence that there must be something else going on, but it's not to be completely dismissed. But
to discount future returns, and hence we see a decline in Q and the PE multiple, is that not just say, for example, there's been such a good run in the market over the last, in this case, almost 10 years, and the chances of this continuing in the near future, the probability is going to be quite diminished. Now, people might discount those returns, but what's really changing these more so is the variable price, or in your, so the prices is really kind of changing these because earnings don't change as quickly.
Oh, absolutely, but the earnings, actually are pretty volatile. So remember, what we're doing is we're stripping out. We're averaging out earnings over a 10-year period. So we're getting rid of a lot of volatility in earnings. We have to do that to make CAPE work at all. Yeah. What's happening is that it's the valuation of the expected stream of earnings that is changing. And the question, the big question in this area is that a sort of rational valuation reflecting investors' actual genuine preferences? i.e., if the valuation doubles, is that because, roughly speaking, is that because the discount factor has halved? So that on average, people seem to want 6% on their stocks, but is it possible that now they only want 3%? If they only want 3%, then you can more or less justify the current valuations. And actually, in the current context, that the typical investor, if you talk to investors, they will be pretty happy with 3%.
Yes.
because there isn't much, there's so little else on offer. And it is a very big contrast with 1999, where the previous peak, when the prospective return on equities was even lower, if you try to think of it in rational terms. But the return on competing assets, back in 1999, the return on American index bonds was 4%. So getting out of the American stock market was a no-brainer in 1999. But if we're thinking about it in terms of asset allocation, it's far from clear that it's a no-brainer in the current context. Yes. We've sort of got into the sort of fundamentals of this. My personal view is that I think it is plausible to say that markets do have periods of over or undervaluation driven by, actually primarily driven by just the the difficulties of setting up social arrangements to correctly value markets and correctly enforce value of markets.
How, and in what way, like failure?
Well, I mean, the one point to make is, and this is why I say I don't think I'm doing anything that's departing from the mainstream, because you referred to the efficient markets hypothesis. It's mainstream economics says that the efficient markets hypothesis is a logical impossibility. Grossman and Stiglitz, 1981 or two, pointed out what had actually been known for a while, that you cannot have a perfectly informationally efficient market, because if you do, then everyone will free ride on the information, and if everyone free rides on the information, there is no information. So you have to you allow for the fact that markets must be at least somewhat imperfectly efficient. There must be some noise in stock markets, otherwise there will be no incentive to get the information.
Oh, I get you. Like noise traders and
stuff like that. So there's that's mainstream finance. That's not eccentric stuff. I think even Eugene Farmer would agree on that. I think the distinction with Eugene Farmer would be that he would say, okay, yeah, there's a limit to how efficient a market can be, but it doesn't matter very much. The market is as efficient as it can get, and therefore we'll carry on assuming it's efficient, but not because we really believe it's efficient, but because it's a good approximation. And economists like good approximations. They're not trying to do exact descriptions. But I think my judgment, and Andrew Smithers, I think, who I've worked with, would put this more strongly. My judgment would be that markets in a world where most of the investments being handled, there's the other people's money problem, that the fund managers who are tasked with doing the very difficult job of deciding what to invest in are judged on relatively short horizons, and their incentive to arbitrage away, even when markets look severely overvalued, the incentive to arbitrage away for fund managers, for professional investors, is incredibly damped. Andrew and I made the point back in 2000 that even at the peak in 1999, I'd done some calculations with Donald Robertson on sort of the probabilities of the stock market falling. And remember that, these valuation indicators that we're seeing here, they're warning indicators. When Q gets high, it's a warning indicator that returns are going to be poor at some time in the future. But it doesn't say when. The predictive power of a valuation indicator 1 year ahead is very, very small. Something like it explains 5% of the variance of returns. At longer horizons, the fit becomes better, but 1 year ahead, it becomes very small. So even when we were at the peak in 1999, the probability of the market falling the following year had risen from the sort of historic average value of around 45%. Mostly the market rises. Market rises a little bit more often than it falls, but only a little bit more often than it falls. So normally the probability of a market fall is about 45% in rough terms. We calculated that by the peak in 1999, it had risen to something like 60%. I mean, very, very broad orders of magnitude, which meant that, yes, it was a significant shift in probabilities. But if you think about that from the point of view of a professional investor, that said, there was a 60% chance that if they stayed in equities, they would lose money. But there was a 40% chance that if they got out of equities, that equities would carry on rising and that they would get fired.
Yes.
And they did. Those who were conservative and did get out, very famously Tony Dye in the UK, got out in 1998, 1999, and were fired.
But that's the thing, like those 2 years were quite significant in the final phase of the bull run.
Mm-hmm.
And, the amount of profits that they had missed out on, and it's unfortunate that he was fired like that, but he had, and, no one listened to this type of argument back in 98, 99 either.
Well, they did listen. That's the point.
Some people did. Most people didn't listen though.
Well,
because it would have been.
I mean, the interesting thing is, I mean, I was working with Andrew Smithers there. He had this fund, the advisory company, Smithers and Company.
Yeah.
And he met fund managers regularly. And he had Andrew came up with a nice phrase, the fully invested bear.
Okay, nice.
Pretty much everyone he met was incredibly pessimistic about the American stock market. Oh, wow. And pretty much everyone he met was 100% invested in the American stock market because they had to be. They had no professional alternative. And, you know, if we could devise a better social arrangement for you know, making these kind of investment decisions, then maybe these kind of overvaluations wouldn't get so extreme. But I can't actually think of one off the top of my head. You know, it's not. Yeah, it's not like I think the government could step in and do a better job. I think it would probably do a much worse job.
But sure, even what's happening today, Trump blaming the Fed for the recent decline on the stock markets, for rising interest rates, and then people blaming Trump, it's because of the tariffs. And that social interaction isn't a healthy argument, because people are looking for reasons as to why there's a decline in the markets. And it may have nothing to do with this.
Well, I mean, I think it probably does. I mean, it could be, you know, I think both arguments are reasonably plausible. Yeah. I mean, I think probably the argument about the Fed is more plausible, because, you know, one of the things I was saying to the people I talked to yesterday is, you know, yes, the market on these metrics, looks fairly seriously overvalued. You know, I mean, not very much, you know, on a par with what we were seeing in the late 1929, you know, just to put, actually somewhat above what we were seeing in 1929. Yeah. And that was at the peak in 1929, and so that figure shown there. But what I was saying is that actually in the current context, it would be astonishing if the market wasn't overvalued, because, you know, it's been the objective of monetary policy for the last 10 years to drive up all asset prices. Yeah. It's been a clear-cut objective. I mean, you know, explicitly in terms of bonds, but obviously you can't drive up the price of bonds without driving up the price of other competing assets. So, you know, it's really not surprising that we're where we are. And it also shouldn't be surprising that if we do move to something that looks more like business as usual in terms of bond yields in America, then it will be very surprising if it didn't have a bad effect on the American stock market. I mean, in some senses, it's surprising that it hasn't had a bigger effect, but, you know, but yields haven't really gone up very much yet. We're still, you know, we're still barely factoring in more than a small positive real interest rate, you know, given normal expectations of inflation. So, you know, it could be if we get a more significant normalization, then, you know, you might well see the market fall. But I mean, God knows, I don't forecast the market. It's not the business I'm in.
Just a question. These are expressed on logs, are they?
Well, this is actually they're not in logs. This is just on a ratio scale. So
okay,
yeah,
yes, I see it.
Yeah, so it's a lot, otherwise known as log scale.
Okay, like it is quite worrying seeing, for if you're heavily invested in the markets, to see this chart for both the CAPE and Q that they're twice their historical average value. And as you mentioned, it's slightly higher than what was in 1929, and it's catching up to what was in 1999, and it's beyond what was in 2008. So again, we have different circumstances, but they do tell and maybe even foretell what is the likely chance of, well, I don't want to say chance, but what's the likelihood of a stock market decline in the near future, whether it's in 6 months or 6 years?
Let me qualify what I mean. This is sort of the headline picture. You know, if we just simply look at Q and CAPE, but let me qualify it in two ways. I had a range of charts here, but I'll skip through. This takes a bit of explaining.
Okay.
But this chart, well, actually, it doesn't. From the sound of it, doesn't take explain to you because you've read my book, but almost no one in the world has. So I'll have to try and explain it myself. But notice that this chart doesn't run up to the most recent past. It only runs up to 1999.
Okay.
And what we're doing here is we're using this concept that I introduced in the book of hindsight value, where at any point in time, what we're doing is we're actually looking into the future. And this is a sort of summary measure of future returns at any point in time. That's why it's called hindsight value. And the idea being that with hindsight, we know when the market was overvalued and when it was undervalued, because using our definition at any rate, a period of undervaluation was a period that was subsequently followed by good returns. A period of overvaluation was a period that was subsequently followed by poor returns. This is on the assumption that expected returns are reasonably stable. Yeah. In farmers' world, that wouldn't be the case. But if we take the idea that expected returns are relatively stable, or if you like, just think of it in terms of some investor who has a stable expected return of around 6%, which is, the historic average return on the American stock market, then 1929, we now know for sure was definitely a terrible year for that investor, because they would have liked 6%, but they got, roughly speaking, whatever horizon you look at, this is averaging out across horizons, whatever horizon you look at 30 years into the future, it was a terrible time to buy the stock market relative to that benchmark of 6%. Whereas 1932 was a really good time to buy the stock market relative to that benchmark of 6%, because you got very good returns. And actually, the Second World War and just after the Second World War were even better than that, as was 1980. The thing is, when we look at those years, what we do is we look 30 years into the future at any point in time to make the most of hindsight. And the book explains how it's done, but it's basically averaging out a group of investors who have different investment horizons. What would they have bid for the market had they known what actually had happened? And so we can say with some certainty that in the early 1980s, the market was distinctly undervalued because the returns from the 1980s were really good. The trouble is, from 30 years ago, we start to run out of hindsight, because we cannot say, we haven't yet got 30 years worth of returns to say whether it was a good or a bad time definitively.
Yes.
However, it turns out that what we can do is that we have got, where are we? It's 2018. We've got, since comparing 1999, we've got 19 years worth of hindsight. So we know that returns since 1999 have been pretty bad on average. So that's already in the data. So all we then have to do is to say, well, what do we think is going to happen from now on, and take a very broad range of guesses of what might happen from now in the remainder of the 30-year period. And so what I'm saying is I took guesses ranging from 0, which is your very, very pessimistic case, to up to the historic average return of 6.7%. And I feed those in for future returns, but use the actual data we've seen since 1999 up until today to fill in the rest. And the thing is, it doesn't make much difference. No. Whatever way you compare it, what's happened since 1999 has revealed that the market was pretty seriously overvalued in 1999. However, it wasn't as seriously overvalued as Q said it was. We couldn't know that at the time, but if you look back at Q in our chart, it was well over 2.
Yes.
Oh, sorry, Kate was well over 2 and Q was over 2. Actually, to be honest, at the time, in the data we had at the time, I think the Q number was actually higher than that. So I think we can say that actually CAPE and Q, they were sending the right signals in 1999, but they were overdoing it. And we know that the price dividend ratio, the dividend yield was, would have said that the market was 4 times overvalued, which was just completely out of range. So with the benefit of hindsight, we've got a little bit of a sort of test really of the recent forecasting power, of the recent sort of, forecasting power of Q and the P multiple. But then there's another way of looking at it, which is if you go back to the original chart and say, what drives these two series? Why do they look so similar? And the reason they look so similar is that they're basically both driven by returns. When returns are good, they both rise. When returns are poor, they both fall. And this does take us back to Farmer and French, who pointed out a long time ago that actually there's predictive power in returns.
Yes.
When returns have been good, it predicts poor returns in the future and vice versa. And so there's an alternative way of looking at the market, which is to say we're not sure if we completely believe either of the fundamentals for Q or for CAPE, because with reason, there is reason to be skeptical about those fundamentals. There are serious measurement problems in both of them. So what if we just ignore the fundamentals, and what if we simply say, what do we know? What can we tell just by looking at the history of recent returns? And this is something I sort of developed a while back, and I've done some work with Donald Robertson on this. So what we get is that we get what we call a pseudo valuation indicator, which is purely driven by a weighted average of current and past returns, with a slow declining average, a very slowly declining average of past returns. And actually, for those of you of a technical disposition, this comes from you can justify this using an ARMA model of returns. And the 0.98 coefficient is in fact the MA coefficient in the ARMA model.
Yes.
And basically an ARMA model of returns gives you an MA coefficient very, very close to 1. And it says that a geometric average of current and past returns is you end up that's being the best prediction. And look at this. Now compare this with Q, which is now a slightly different shade of blue. The red series is our pseudo valuation indicator. And until around 1990, you can hardly tell them apart. Until around 1990, it is true that Q does a little bit better in forecasting returns if you take it to econometric tests. But if you do econometric tests on CAPE versus this pseudo valuation indicator, actually CAPE does less well than this.
Okay.
And which makes me, somewhat skeptical of CAPE. I think it's been overstated. The benefits of CAPE have been overstated. Because we smooth out the earnings so much, there's virtually no informational content in the earnings left.
Can I interrupt you here for a moment, Stephen?
Yeah.
Just to clarify on the pseudo valuation indicator in Q. So Q and CAPE, you're assuming that there's a possible errors regarding the fundamental calculations, and therefore you want to be able to identify or track these variables against pure returns, and the pseudo valuation indicator is your pure returns because it's a geometric weighted average of current and past. So therefore, if your current and past returns create this, it looks like an average of approximately 1.
By construction, it's approximately 1.
Yeah, and so we see in cases where it does fluctuate something very similar to Q, and I'm sure similar to the CAPE as well.
Oh yeah, absolutely, very similar.
But then it breaks away, as you suggest, from 1990, and definitely you'll see it's more quite different, even from the year, I suppose, 2002 onward.
Yeah, absolutely. So I mean, I think that's the point. Most of history. Until around 1990, they were driven by very similar things. And remember, as I said, you shouldn't be surprised because, Q rises because there's strong returns. Q falls because of poor returns. So, that's the dominant factor in both of them. And there is predictability in returns. There's a big academic literature saying that there's univariate predictability in returns. Although when I say there's a big literature on that was Farmer and French's original contribution, but the empirics last time I looked were actually focusing more on multivariate predictability than univariate predictability. But there is univariate predictability. But then, yes, as you say, coming up to 1999, you begin to see them diverging. But I'd already said to you that I think Q was overstating overvaluation in 1999. The hindsight indicator that we have suggests the market was only around twice overvalued. And so actually the univariate indicator was probably closer to what if you like you to call a true measure of overvaluation than Q was in 1999. But they, of course, was telling very similar, they were telling very similar pictures. And that was again, it was one of the things that made 1999 a no-brainer, really. It was because everything was pointing in the same direction. But then from 99 onwards, you can see this divergence. Basically, what this red series is capturing is that returns since 1999 have not been very good. They've been fine for the last 10 years, but relative to a benchmark of the historic average return of 6 or so, the returns that we've seen since 1999 were really very poor. And so by the time we got to the trough in 2009, we'd had a long run of very poor returns, which means there was a prediction of good returns. And lo and behold, we got good returns. But now, where do we stand? Well, we're more or less at the historic average.
Which is not worrying.
Well,
according to this indicator.
Which is not worrying, absolutely. So if you only believe that predictability of returns is the only thing that there is out there, you would say there's not any particular reason to worry about the American stock market. And all that's happened is that monetary policy has pushed it up from a low point in 2009 to give you what this is saying is that, we're back on the sort of the historically normal returns of 6 or so percent.
Therefore, now, markets are efficient, you could nearly say.
Well, you could, if you like, or you could simply say, even if you don't believe markets are efficient, you could say, this is an alternative way of looking at it, an agnostic way of looking at it, that would say there's not much evidence for overvaluation. Now, I'm going to be the classic two-handed economist and say I think that probably the truth lies somewhere between that line and that line.
So 1.5.
Something like that. I think one argument would be, this line would say the returns don't look obviously bad, they don't look obviously out of norm compared to a benchmark of 6. I think I would say on that actually I think the benchmark of 6 or 6.5, which is the historic average return for America, is almost certainly too high. I think I don't think that that's the kind of return that investors actually do expect these days.
I agree with you, especially with the lower interest rate environment we've had since the 1990s anyway.
Well,
if you want to make a comparison, because the expectation of beating risk-free interest rates when rates were higher, and the trader would have required a higher return, a stock market return.
Okay, well, be careful of that argument.
Okay.
I'll come back to that argument. That argument has some holes in it, actually.
Great.
I would say it's more that actually, just simply if you look at stock returns, American stock returns have been pretty high compared to the international average. Damn it! I thought I had a chart of the international average, but look, there we go. This is plotted against GDP growth. By the by, pointing out that there's no correlation between growth and equity returns. But there's the USA. You see, one of the highest returns over this is a long sample, 20th century up till now. Yeah.
Yeah.
Only the Australians and I think that's South
Africa,
has a higher return. Most countries have returns more in the range 5%, 4 to 5%. There's Japan with 4. The UK is, where's the UK in there? I can't see it.
I can't believe Ireland's the only one on the line.
Yeah, Ireland's on the line. That's right. There's the UK with 5.5%. I think the UK is an interesting stock market because basically Britain is the most boring country in the world. And as such, the thing that drives, remember, returns is a combination of expectations and surprises. I think Australia and the United States have done over this period, remember, this is a long period, they've been surprisingly successful economies. The European countries, a number of them have been, have had some very nasty surprises during the course of the 20th century, particularly in the first half of the 20th century. There's good old boring Britain. Oh, look, and there's good old boring Switzerland. Nothing much has happened to these countries in comparison with these, neither lucky nor unlucky. And in those countries, stocks have yielded something like 5%.
Would you think that'd be more accurate? Because they're quite good returns if you're measuring against GDP growth.
Yeah,
So,
I don't think you should measure it against GDP. Look at this chart. Does this chart tell you GDP growth has anything at all to do with
no,
returns?
it's nothing to do with it, but I'm just saying, like, given that economies are growing slower than, say, Japan at the higher growth rate, they're getting good returns relative to Japan, say, over that historical period.
Yeah.
But then there's no correlation, as you say.
There's absolutely no correlation. It's one of those great, I think the idea that the two of them are related is almost entirely
It's like saying invest in gold as a hedge against stock market crashes, and it only shows a slightly negative correlation, which doesn't mean that it's a good hedge.
I don't think it's going to help you much.
No.
But coming back to your point about, so I would say the benchmark for stock markets, for global stock markets, is probably a number closer to 5 than 6.5. And that's the historic benchmark. I think at the moment there's lots of evidence that fund managers are prepared to accept returns a lot lower than that, or have down-rated their expectations, somewhat. They're still hoping for positive real returns, but they're not. I don't think they're expecting even a number as high as 5. At least the conservative ones wouldn't be. But come back to your point about the risk-free rate. This is another chart we talk to fund managers about a lot. And this brings out the point that the blue line is 30-year average rolling return on stocks over the full period since 1800, actually. So this is the Jeremy Siegel database augmented with the Schiller and S&P data set, all in real terms. And what we see is, there are fluctuations in the stock market, but the average return is never very far away from 6. And therefore, if you had to ask me, looking another 100 years ahead into the future, I would say with, not with certainty, but with a degree of confidence that I would expect the American stock market will produce a return of maybe not 6 because other countries haven't done so well, but maybe 5. 5 or 6 for the next 100 years, with, lots of volatility seems a plausible estimate based on more than 200 years worth of history. It's the best we can do.
Yeah.
But if you were to ask me, what is going to be the risk-free rate on average for the next 100 years? I would have to say, I have no idea. Look at these numbers. In the 19th century, the real risk-free rate was around 5 or 6. In the first half of the 20th century, it fell to sort of around 2. For a long period, it was negative. Then, we had this stable period of around 2. And then, of course, in the recent past, it's come back towards 0 or lower. And, the bond return has simply matched the shifts in interest rates that we've seen. So, there were massive capital gains on bonds in this period. That's what's driving it. The capital gains came because the yields were going down. I don't know. I have no idea what the risk-free rate is going to be for the next 100 years.
It'll be interesting to match all of this based, like, say, the cash chart for the risk-free rate of return. It'd be interesting to map it against periods of types of the economic policy adoptions, Keynesian monetarists and so on, and also the creation of the Federal Reserve and the gold standard, and whether these type of policies have been loosened or they realised that reducing the risk-free interest rate is better for economic growth overall. And then into the future, we could have different types of policies based on a new type of economic thinking, or
absolutely. Who knows?
Who knows exactly
what will happen in monetary policy? When you look at stocks, the thing is, the universe of stocks that we're buying now is radically different in terms of what companies produce. But in terms of the incentives that drive those companies, it's basically the same. It's still limited liability, and the profits are still the residual claim on output. It's not really any different what you're buying. But what you're buying when you buy a government bond is totally different today to what it was 200 years ago.
So like that question that I had posed earlier on about the interest rates, according to this diagram, historically, it's like as if there's no relationship at all between the two.
Absolutely. What Andrew would say, it's the myth of the equity premium. It's not to say there isn't an equity premium. What I would qualify what he would say to say it's the myth of the stable equity premium. There's very little evidence of a stable equity premium, and indeed now, guess what? Wearing my mainstream academic economist hat, I would point to the fact that there's quite a lot of literature over the last 10, 15 years that has pointed to a clear to fluctuations in the equity premium that are have some kind of countercyclical component. Okay. So, the equity premium has almost certainly expanded significantly in the crisis. The alternative way of looking at it is really actually it's about the appetite for risk-free for purely risk-free assets has expanded very significantly in the recent past.
So going back to Trump's argument of criticizing the Fed, you could almost say to him, well, based on the historical average or the historical data, that what the Fed is doing regarding the changes in the interest rates has nothing to do with what's happening will have nothing to do with what's happening in the stock market in the short to long term, unless you're a noise trader.
Well, yeah. I mean, I wouldn't say it would have nothing to do with it. I mean, we need to distinguish between valuation, our arguments here would be, given the complete lack of predictability of bond returns, you can't value stock markets with reference to bonds. You can't value them. You can only really value them relative to historic normal returns on equities themselves. But that is not to say that people don't look at competing assets. Of course they do. And if we're in a world where competing assets are earning, barely a positive return, and then we shift to a world where competing assets are earning 2-3% real, it would be very surprising if that didn't have an effect on people's asset allocation decisions.
Like even
driving the stock market down,
Yeah, like even people would use different bond prices and look at the spread between, say, a 5-year and 10-year or a 30-year, and if there's a crossover, they see that historically and be able to map it out against changes to the stock market returns. So not only just looking at bonds over a historical period, but looking at one type of bond against another could, as some might suggest, be an indicator. People, and indeed, there's some evidence of that. If you look at the slope of the yield curve, it has some predictive power. It's not really surprising, particularly that it does, because it's a summary indicator of what people think is going to happen to monetary policy. There's something in that. I mean, this isn't really help. This chart doesn't help because this is realized returns. So remember that this very strong return on bonds is driven by the capital appreciation element in bonds as yields fell. Remember, they're moving in opposite directions. You wouldn't mind going back to the previous diagram on your Q and P? Yeah. It's just interesting. If you look at, say, the rise in both of those indicators from 1920 to 29, then you see maybe the 1994 period up to 99, and then make a comparison after our own financial crisis recently. They seem like the last one seems a little different in that there's it's like steps up to the current high of about 2.2. And is that corresponding to the 3 levels of quantitative easing that were introduced?
I think as I said at the beginning, quantitative, given what's been going on with quantitative easing, it will be surprising if the stock market hadn't risen in response. That's been buoyant. It definitely has helped to buoy out the American stock market. On top of which, of course, I haven't got a chart of this, but, one thing to bear in mind is if you actually look at who's buying the American stock market on the back of quantitative easing, it's the American corporate sector itself is buying the American stock market. So if the American stock market corporate sector stops buying itself, then that's also not going to be very good news for the American stock market.
Stephen, you mentioned earlier on about they're not a great predictor, and you're not in the business to be forecasting either and trying to predict things. But you were presented to. Did you say you were presented to fund managers yesterday or hedge fund?
I was, yeah.
And are they looking for insights into how they could use Q to help them use that as a risk measurement tool? Or do they look at more simple techniques like the price earnings ratio, which isn't a lot easier in terms of the calculation? Because I saw your data set on Excel, which is available on your webpage, your university webpage, and it is a lot of information compared to Schiller's own information on calculating CAPE. And it's somewhat off-putting. Especially if you don't have a historical. Sorry, Stephen. Sorry.
No, absolutely. Point well taken. Well, I did mention earlier on that Robert Shiller is obviously a more organized person than I am. But yeah, I mean, actually, to be honest, the updating Q is very easy because in the recent data, it just comes straight off Federal Reserve data sets. It's just, my data set was designed to give people, was focused more on academics than the average user. I was giving them a whole bunch of data that they could do other stuff with in principle. There's a load of data that you don't need for Q at all. I'm sure I could have made it a lot easier for my users, if I'd simply given them a spreadsheet with two numbers in it, with two series in it. But that's actually really all you need. I'm trying to think, Smithers and Company used to keep an updated value of Q. But Andrew Smithers is now retired, so I don't think that's being done anymore. But or maybe you can make that one of your objectives, Frank. You can tidy up my data and by all means put it up somewhere where people can find it.
But we can't do this for the UK or Ireland because we don't have that historical period to work off, because the United States have the financial regulations whereby they're making companies to report all of this information.
Mm-hmm. No, absolutely. You can't do that.
So is there an alternative?
But you can do this.
The proxy.
The proxy. Yeah.
Or the pseudo valuation indicator. Yeah.
Yeah.
But then, I've
done that. I've done that for the UK, and you get pretty similar answers.
But I've looked up a website. I don't know if you're aware of it. ADVFN. I don't know what it stands for.
No, never heard of it.
But they have a lot of indicators, and one of them is Q. Or Tobin's Q, they actually say Tobin's Q, and they're giving this equity Q or Tobin's Q for every company. And I looked at it for some companies like Tesco a couple of years ago, and I just wonder how they actually come across this type of measurement.
No idea.
Yeah.
One of the things we always have stressed is that we're viewing this as a way of valuing markets as aggregates. Mm. Viewed as a valuation criterion for individual stocks, it's, all sorts of problems arise. Mm. We have remember that in individual stocks, what you're valuing is the assets that they own, the productive assets they own, but you're also valuing the capitalized market, the capitalized monopoly profits that they're going to earn in the future. And so if you take a company with currently very strong monopoly power, its valuation can be extremely high relative to its underlying assets. And that, I assume, is the kind of calculation that these guys are doing. I mean, I have seen people saying that they're quoting Tobin's Q for individual companies. And what you do have, and which is widely used, is the market to book ratio, which is not very far away from Q, but it's just, the problem is that it takes book value data, which is has all sorts of distortions and is not inflation neutral and so forth. But I would guess that what these people are doing is using something related to the the market to book ratio. Like
the recent acquisition of Sky by Comcast, there was a $2 or £2 premium over the current market valuation and the one that Fox had put on it. And I don't know, like if there was such a thing, equity Q for Sky, I know it's terrible to say this, but let's assume it, and Comcast came in with this overvaluation. Mm-hmm. The price reacted to reflect that type of bid. How is it that a company could still maintain that value after the purchase? And is there something about intangibles relative to tangible assets such as goodwill or brand valuation like Coca-Cola, whose brand could be worth more than the company itself?
Yeah, that's my point. Brand value, if you want to call it brand value, I would just say more generally, it's just capitalized value of monopoly profits.
Okay.
So yeah, a company can be worth, if it's expected to make sustained monopoly profits for a very, very long time, a company can be worth very much more than its actual recorded assets. Mm. But I mean, as I said, we focus on aggregate markets, but I mean, I think that again, there is a big literature in finance on individual stocks, where you can use book to market value, market to book data as an indicator as to whether you should expect high or low returns from a company. And guess what? It also has predictive power. Actually, in a crude sort of way, it's not that inconsistent from what we see in aggregate Q, because what we see is that companies with high market to book ratios typically have poor returns. Again, and guess what? Farmer and French have pointed this out. Okay. Those hardline free marketeers have done lots of work on this, and they tell it. They don't tell a story about overvaluation, but they've pointed out the empirical regularity. Yeah. It's the so-called value effect. Firms with low valuations relative to their underlying assets actually have higher returns on average.
Yeah, that makes total sense, really, doesn't it?
Well, I wouldn't say it makes total sense, but it's consistent with what we see in the Q. Yeah. It is one of the great puzzles, I think it's actually, fun enough, it's one of the things that I think is hardest to explain in the context of an efficient markets framework, because you have to explain it as a risk premium. And it's really not at all clear why there should be a risk premium on value companies.
It's I kind of get worried when I say that makes total sense, and that's obvious that there's no relationship here and there. And these in economics, you have one of the first things you're introduced to is normative and positive statements, and you want to be very careful to how I word things, because it doesn't necessarily mean that it's 100% accurate unless we have the data to support it.
Nothing I ever come across ever makes perfect sense. It's one of the reasons why economics doesn't have any laws. Or when people talk about laws in economics, they're nearly always proven wrong in due course.
Like, I was lucky to have bought your book, Valuing Wall Street, Protecting Wealth in Turbulent Times, at the time, looking at the Q ratio. Do you have anything that you'd like to suggest for anybody to take a read of, other than your work, in which I'll actually put up on the website?
Oh, goodness me.
Smithers and Co.
No, I haven't. Yeah, you see, Andrew Smithers is always worth reading, and he's got a new book coming out in the summer. He's had several books published since we wrote Valuing Wall Street, but oddly enough, I haven't written much on this since that book. I've talked about it quite a lot, but I haven't written much down, so I don't really have very much to point to, I'm afraid. I wish that I did, because it would be good publicity for me. And if I was Robert Schiller, I would have done it. But he's got a lot higher energy level than I have.
Stephen, I really appreciate you taking time out. Thanks very much.
You're welcome.
Great. All the best.
Okay,
thanks.
Great.
A good weekend.
Cheers,
bye.
Frank. See you then. Cheers. Bye.
Economic Rockstar is a free podcast that does not exclude anyone from listening, as long as they have a device to listen, download or stream. I have many listeners from all parts of the world, and I truly am pleased to know that the Economic Rockstar podcast unites all of you through the common theme of economics. I strive to commit to releasing an episode each week and aim to develop Economic Rockstar into much more than just a podcast. Patreon is a platform that gives you, the listener of the Economic Rockstar podcast, the opportunity to express your appreciation of the show by committing a financial reward for as little as $1 a month. Patreon allows me, the creator of the Economic Rockstar podcast, to be rewarded and paid by you, so I can continue with the running costs of the show and to reinvest and expand the podcast into other platforms or mediums in the future. To find out more on how you can help the Economic Rockstar podcast and have your name added to the supporters list on my website, please check out my Patreon page at patreon.com/Economic Rockstar, or visit the supporters page on the Economic Rockstar website. If you enjoyed this podcast, why not leave some feedback or comments on the show notes page on economicrockstar.com, where you can also sign up and be a member of the Economic Rockstar community. If you're listening to this episode on iTunes or Stitcher Radio, I would love to have some feedback and for you to leave an honest rating and review, as this will help with the rankings of the show so that more people can find it. If you're listening on the website economicrockstar.com, make sure you check out the back catalogue of all previous episodes and interviews with some amazing professors and authors at economicrockstar.com/podcasts. Thanks for listening, and I really appreciate your loyal support. I know how much you love audio, so why not get a free audiobook with Economic Rockstar today? I've teamed up with audiobooks.com to bring you this amazing offer. Visit audiobooks.com/rockstar to download your free audiobook now.